Hi, everybody. It's great to see everybody. We love seeing everybody's faces. We're very excited for this panel today. For those of you that I haven't met yet, I'm Jessica Peltzatula, founding partner at Hannah Gray. CTN and I co-founded Women in VC in 2015. So just a quick background, if anybody's just curious about community updates. Started this here in New York in 2015. We've since scaled it to now the world's largest community for women investors. We just hit over 3,500 women across more than 2,000 venture firms in over 180 cities, 60 countries. Our Slack group now has over 100 active channels for you guys. These are really meant to be subcultures and micro communities within the broader organization. Because as you all know, we see women in VC as a canvas and giving you the tools and the foundations that you need to connect, to be successful, to have resources, to share deals, to help each other, because that's really what this is all about. So on today's panel, we're going to talk about something that has become really important to Sutian and I, which is how can we help more women raise bigger funds faster? So this is kind of coming off of the heels of the research that we published last fall. But I'll hand it over to Sutian to introduce our panel and thank First Republic, who's been an awesome partner for us in terms of just putting together this content and these speakers. Both Jamie and Lisa are also members of our community too. So it's just awesome to come together and have this transparent dialogue because again, we want to help each other win and be successful and learn together. So Sutian, I'll hand it over to you. And all questions, please drop in the chat and we'll get to them at the end.
Yeah, awesome. Thanks, Jess, and hi, everyone. It's super exciting to see all your faces. And we were just talking before we let everyone in, like, oh, wouldn't it be nice one day to have this IRL? And so coming up soon at some point. But I know there's a lot of folks who are interested in hearing not from Jess and myself, but from the panelists today. And so I'm thrilled to have such a great group of LPs here. Caroline, we've been working with for a really long time at First Republic. Caroline was previously a VC, so I think brings wears a bunch of hats and brings a lot of perspective to that space. And she'll be leading the discussion between Jamie and Lisa, who are both LPs and very active LPs within the emerging managers space. And between the two of them, which I've had the sort of pleasure of knowing for a while as well, they have there's sort of just a font of knowledge around like what to do, what not to do as an emerging manager, what LPs like to see, what they don't like to see, and so we're going to ask that everyone holds their questions until the very end, but to please drop them in the chat so that we know we can sort of plan around timing and get to everyone's sort of like burning questions. And so without further ado, I'm going to put everyone, let's see, I'm going to put all the panelists on Spotlight. And there we go. All right. So Caroline, take it from here.
Yeah, thanks, Sutian. Thanks, Jess. This is a lot of fun to be here with all of you ladies today. As Sutian mentioned, I used to be on the venture side and was involved in this community until I became a banker. I joined First Republic a year ago. I was at Resolute Ventures, Propel Venture Partners, and Sherpa Capital for 10 years. And through working through Resolute Ventures and raising our fourth fund, I got to know the First Republic team really well and decided to come and join the connective tissue and the efforts for helping our GP and LP clients. So I'm excited to be here today. But the brains behind it all, Jamie and Lisa, the three of us are excited to give you a little bit of information that we can cover in an hour on fundraising strategies that you should all know. So Jamie and Lisa, let me pass it off to you for a quick intro.
Sure. So I'm Jamie Rhode. I work for Verdis Investment Management, which is a single family office. We manage capital for generation 7, 8, and 9. And for us, we've been invested in venture since 2006. But in 2016, we really shifted around our venture portfolio to be solely focused on early stage. The goal of our asset allocation for venture capital is really to compound the family's capital for another 200 plus years. And it's really why we are very focused on getting access to that first institutional check-in. And I've been with the family office for 6 years now. And prior to that, I was at Bloomberg on their credit analytics and equity research side.
And hi, everybody. It's also great to be with you guys today. I am excited to see some familiar names here too, so that's fun. I focus my time on our venture fund platform at Knollwood. I've been with the firm for 7 years, and Knollwood is essentially a multi-billion-dollar investment firm, and we're based just outside of Baltimore. We've been around for about just over 30 years, and our portfolio is comprised of both liquid and illiquid platforms. We invest in fund, direct, secondary. And in terms of our approach to venture, we invest from the earliest stages as a collaborative partner, and then all the way as a life cycle investor up through the private markets or public markets at the end. We take a partner first approach, and that's translated into investments all over the world. So everything from, here in the US to, China, India, Israel, Korea, MENA, Latin America. And I think throughout today, we're certainly here to provide some insight and perspective, but you may hear me continually reference this relationship and partner first approach. So, I think what's really interesting and helpful for managers to take away from both of our backgrounds and some of our introductions is just that, we're both family offices, but that's where the differences stop. So we have similar interests, similar end goals, but we both have different strategies and take a very different approach to venture.
Awesome. All right. So I know you both feel very passionately about the fundraise process. So would love to hear from you both on what does an ideal fundraising process look like? What are proper steps that each manager should take from the very beginning?
So I think, try and do research ahead of time, but to be honest, especially with family offices, there's typically not a lot of information out there. And just for some background on it, it tends to be from a security and protection standpoint. They don't want their information out there. They don't want you to know who they specifically are. So a lot of times in the beginning and early days of a family office, they take extra steps to make sure you can't find out about them. So you can try and do your research ahead of time. But I think what is really essential is, when you first start that intro call, you need to interview the LP. You need to spend the first 10 minutes really understanding who they are. What is the firm background? What's the team makeup, specifically the venture capital team? Is it a pretty large organization, or is it only 2 or 3 people? You also need to understand what's their venture experience. Are they knowledgeable in the space, or do you need to spend the beginning part of the call really explaining to them the difference between seed stage, Series A, Series B, and how this ecosystem works? And also, I think it's important to understand what their general process looks like. So for us, Lisa's very relationship driven, but the very beginning process for us is extremely data driven. Back in 2015, we shifted our portfolio strategy around to be solely data centric and data driven in regards to investment decision making process. And that started on the public market side and then moved over to venture capital and all the other private asset classes we invest in. So knowing that up front, that for us to make it over the next hurdle is very data centric, is important to know that that's what you should be spending some of the time on the initial intro call on. Versus with Lisa, she's a family office as well. If it's more relationship focused, then you should be adjusting the call and be flexible based off of, this LP wants X and this other LP wants Y. So just be prepared to adjust on the fly and provide the information that they're actually looking for. I also think it's important to know what the goal of their venture portfolio is. For us, it's purely financial gains. We have, a philanthropic part of the family office, but the capital we manage is purely to compound, and it's to compound for another 200 plus years. So if that's our goal, we're not really interested in follow-on and SPV opportunities, but other family offices can be. They can still be part of an operating business or still have a specific sector expertise where they want to dive deep into. So I think it's really important for the first 10 minutes or so to interview the LP and then tailor the meeting specifically to what they need. And please, please, please make it conversational. Don't spend 30 minutes just going through your deck, because in a Zoom world, I could be looking at email and you'd have no idea.
Yeah, I definitely would echo those thoughts. When I think about that first conversation, it is really a two-way street where you're getting to know that LP just as much as they're getting to know you. So, in addition to some of the things that Jamie mentioned, one thing that you always want to be mindful of is managing your time, not just on the intro call, but your time fundraising, because it is significantly taxing. And we know that on the other side of the table as well. But I think one thing to hone in on is you want to understand how much that LP, like how they think about venture in general. So for example, you don't want to spend your precious time with an LP who's not going to be looking to, dedicate time to the asset class, or if they're, not looking to really double down or continue to allocate in the future, that should be a red flag, even if it might be a short-term solution for you. So, ultimately to me, that initial conversation is a decision point of whether you have LP GP fit from the start. And if you should really be spending more time with this firm and with this person. Maybe it's, not the right contact and they can help get you to that spot. So it's really about whether you both want more. And keep in mind too, it will never be just one phone call, though if you find yourself in that situation, congratulations and proceed with caution. Just be mindful, but it really is about playing the long game. I think one thing I would really emphasize, especially in how dynamic a lot of firms are today, is that I wouldn't get tunnel vision by, trying to only focus on getting to know a CIO or, the perceived decision maker. I think teams are structured very differently, especially within family offices. So getting to know different members of the team can actually be extremely beneficial for you in the long run. So for example, they might have team members that have different specialties or different sector focuses that can help you in the portfolio down the line. And keep in mind that can apply whether they're actually an investor in your fund or not. Another point would be, each person on that team might have different network points. We all have different relationships, so you never know who can get you kind of to that next conversation for your own portfolio, not necessarily for fundraising. And frankly, there can be natural succession or someone changing their position where, they go to another firm or change roles. And so if you've put all your eggs in one basket, then, you might find yourself a little stuck down the line. So, sometimes that non-obvious person is actually the one that's going deep on your portfolio in the background, and they're probably the one that's pounding the table for you also during that firm's internal conversation. So if you take that mental model, you can really apply that to any firm, no matter what, whether you're talking to me, Jamie, any other firm down the road. And at least for us at Knollwood, to give you a different perspective, in terms of just the word LP, we think much more about the partner, the P in LP, as opposed to the L, and some are different. So we're really looking to build true relationships with people we want to work with for a very, very, very long time, because we also, like Jamie's firm, are looking to compound that wealth over 100, 200, 300 years for the family's generation. So, ultimately, all in all, on that initial call, we're really looking to see if this is both a portfolio fit and if it's a partner fit as well.
Awesome. Good tips for the very beginning. So you guys touched on this briefly. The process can be obviously very different, both on the LP and GP side. Do you mind shedding a little bit of light on what it looks like behind the scenes, and how you can see how the GPs can do their follow-ups a little bit better? What might be a little bit more helpful for you both in particular?
Yeah, so I would say we know generally after the first intro call if you could potentially be a fit or not. And some of that's a byproduct of us being so data-driven in the initial process. And so for us, the key things that we look for is portfolio construction, sourcing, and networks. And if you pass all three of those, then, we are definitely interested in kind of taking that next step with you. But that next step is really different based off of bandwidth and timing. I mean, to be completely upfront, we have 7 to 8 re-ups to do this year in 2021. And our venture portfolio is about 8 to 9 new managers per vintage year. And so, but in 2020, most of our investments were new GPs. So we're absolutely looking for new GPs, but unfortunately, some vintage years just so happen to mean lots of re-ups. And so it's based off bandwidth and timing. But if you are a fit for the portfolio, our next step is going to ask you for specific materials and data. And I find it best to send those materials and then ask them, before we get off the call, do you think we are a fit? And if so, what timeline works for you? just because you have to recognize that just like there's tons of startups out there, there's a ton of emerging managers out there. And I may want to invest in you, but I literally don't have the capital to. So there's definitely different types of next steps, but typically we're going to ask for a specific type of data to look at. And once we analyze that, then we're willing to dive deeper. But I think it's important to note that if I don't have the bandwidth and timing to make that investment, we should continue to talk once a quarter. And once I do have the bandwidth and timing to make that investment, our typical process takes 3 months. But even though we're a family office, it's very institutional. We're going to take you through the ringer, and we're going to make your fund most likely of institutional quality, which sometimes the benefit of that is you can go out and actually raise more capital from more institutional like LPs, because us as a family office is willing to take that time to institutionalize your LPA, talk to your service providers, make sure there's cash controls in place so you don't just steal all the LP's money and run off to some other country. So there's a lot of interesting things that I think that, you have to understand beginning in that process with the family office, but just recognize that sometimes, the next step isn't a phone call 2 weeks from now. Sometimes the next step is a phone call a quarter from now based off of what's happening within our asset class or based off what's happening with the family. There could be other situations based off of how that family office is run where your attention is focused on some emergency situation where we need to find liquidity for some type of taxable or expense that's happening.
And that's where knowing, the LP is really going to pay dividends, no pun intended, because you're going to be able to know, is this a firm where this one person is responsible for family services, tax and reporting to their client, and also evaluating venture? Are they looking at, public markets and the private markets? Is this person, solely focused on venture funds? And so that's going to give you a pulse for perhaps why you might be getting a certain reaction out of them or a certain slowness. Just because unfortunately or fortunately, we all only have 24 hours in a day, and no one can spend all 24 hours of that going through the motions. So, I think what I would focus on that might be helpful for folks is just around data rooms and some of the management of the data. So, there's a ton of sample material that's out there available on the web. I know I've helped a lot of our managers go through, what makes sense for their strategy. And there's no one size fits every manager approach. So, I would recommend that when you're in your early innings of taking, those first few LP conversations, put the data room together. And I want to emphasize that that's not just so that you can, dump all of that information on an interested LP. That's actually, in my mind, not the point. I would put that data room together because it's actually the process of putting it together that's going to help you, the manager, the most. So, when you're putting together things like, an overview on your strategy and your thesis, a portfolio construction model and a projection model, a DDQ, your track record and analytics from it, how you're helping your portfolio companies. By going through the process of actually combining all of that information in a way that you can easily share it, it's actually going to help you refine your strategy, and it's actually going to help you refine your pitch, whether you're starting fund 1, fund 2, going out and getting that first institutional capital. And I think it really just helps you solidify your thesis and make you more prepared for the pitch and to navigate some of the questions that you might get from LPs. So, I would recommend that you kind of do that on the front end. The second thing that I would highlight that's been really, really effective and helpful from an LP viewpoint, I would just focus on being pretty transparent, especially for us as being, relationship driven. Of course, we're all interested in the highlight reel. Like, that is the definition of social media today at times. We're all interested in that, and we want to know that because that's compelling. But what I find the most interesting when I'm having subsequent conversations with a manager after that intro call is when we talk about the missteps or the misses. We expect that to happen in venture. There's a loss ratio for a reason. That is the asset class. But what's intriguing is how people take those missteps, not only just identifying that they might have happened and recognizing them, but how they continue to learn from them and have applied them to their strategy going forward. So I think being really honest, not just with an LP, but also within your own firm, fund, team, whatever that may look like, no matter how early you're starting, that's really going to benefit you in the long run. And, for somebody to say, and it's happened, they haven't made any mistakes and, haven't missed anything. we're all human. So I don't know how realistic that really is and how well that helps develop a relationship. But, in terms of our firm's specific approach, we're always mindful of focusing on our re-ups. You heard a little bit about what Jamie's tackling in today's market pace. We are very much feeling the same thing. And every firm out there is going to have a different diligence approach. But I would give you the analogy of you want to date before you're engaged, before you're married. And because our firm is always optimizing for such an extremely long time horizon, this is just so critical to our process. So while we're pretty flexible and agile when it comes to timeframes and timelines, we just are not focused on, this pressure around week to week decision making. I just don't think, for both alignment between LPs and GPs, I don't think that that's the best approach. So
I also want to touch on the transparency thing, because be upfront and honest, because Lisa and I both do a lot of reference calls. And in the beginning, I'm very data driven, but then I moved to a lot of qualitative factors after you pass through the data test. And if you're going to say something on a call or talk about a value add that you provided to a company, you better believe that we're going to take notes on that and then go find a way to go talk to the company and confirm that. So definitely be transparent, but also be open and honest about those mistakes, because there's a good chance that we will likely find that out. But I will caveat it where I think that Lisa and I have a very institutional like due diligence process, and there's a lot of family offices or even other investors that don't.
Right. So we all know that in the VC world and the LP world, there's a lot more funds out there that you can invest into. So how do you manage the no and to the investments that you're not going to invest into today?
I think that's really challenging, because I don't ever want to say no. I don't want to hurt anyone's feelings, but at the same time, I think what we've learned by investing in so many funds is that, we should tell them as quickly as possible. And it's also your job as a GP to find out as quickly as possible if it's a no or not. Don't push too hard to try to get a yes if it's just not a fit. So for us, we try to communicate after the intro call if we feel like you're a fit or not. And if you are a fit, I think it's important for the GP to understand why. And it goes back to Lisa's point about this is a GP LP long-term relationship. So you want to understand if it's because of our philosophies match. Is it just because I have capital to deploy and I have to just put it into the market and you're just kind of in front of me right now? Like, you want to understand if the capital is sticky or not, because anything you can do to build that relationship for the long term today will make fundraising for the future even easier, because there's a lot of fun ones out there that get capital that's not going to re-up with them, so that you have to be cognizant about that while you're even deploying your fund one, knowing that a percentage of LPs in your fund one will likely not re-up. And if it's a no, is it a no because it's structurally not a fit because of the stage you're investing in, the sector you're investing in, the geography that you're investing in, or your portfolio construction for us? Or is it a timing and bandwidth capital issue? No. And that's one that you should specifically work on building up that relationship and ask the LP, is there something I could have done differently or do differently to turn your no into a yes? And that's where I think you'll really get the good understanding of, is it just the LP doesn't have the time and the capital, or is it just we're not going to make it to a second date, using Lisa's terms, and it's not worth my time? And how should we stay in touch? Just on my email distribution, or do you actually want to have quarterly updates? And should I invite you to any LP GP annual meeting events that I do? So if you so happen to be in town, maybe you could attend, but don't be afraid to kind of ask the why if it's a no.
And I think by asking the why, of course it doesn't change things, but it certainly can help on the mental toll that fundraising can take, right? Like, it is a grind, everybody knows that. But understanding the why, it can help you direct that, natural emotional energy, and then also your follow-up efforts more accordingly. So, you have to think about this kind of like you would think about your own portfolio, right? So you'll say no more than you say yes. And ultimately you will, and should, by the way, invest only in a small percentage of the deals that you actually see. And that's the position that LPs, one step removed, are also involved in. So I would use it certainly as an opportunity to take in feedback if they provide it. But also I think, again, this is where understanding that LP independent of your own fund can come into play. So, for example, some LPs, whether they're fund of funds or family offices or other structures, if they have one sector specialist already in their portfolio, they may be hard pressed to actually add another in that same vertical to their fund portfolio, unless there's some sort of specific mandate. So, if they already have hypothetically a fintech manager or an e-com manager, someone focusing there, if you are pitching that same thing, it's really difficult to trigger that churn and turnover if they can only have, one in their portfolio, just given the long-term nature of the asset class. So, if you know that, I'll continue with my dating analogies here. It's really it's not you, it's me kind of approach that you should take in and understand. And I would use it as an opportunity to understand whether, is this a no right now? So, understand, is this a more long-term misalignment, that this is just fundamentally not a good LP fit for me? That happens, that will happen, that's natural, and that's to nobody's fault. Or is this somebody that says, they want to continue to get to know you, they want to track your progress? And, I would emphasize that, to make sure that you're not doing the, every other week follow-up call, unless they ask for that. There's ways that you can offer this kind of touch point with an LP where it's not going to be a tax and burden on your time as the fund manager or on the LP's time, frankly, when they can opt into the engagement. So, that could go through things like inviting them to your annual meeting, or if you host other events, including them on newsletters and LP updates. There's different ways, again, that you can passively have some of that interaction. And again, it can be an opt-in from both sides. I also would suggest that, in terms of follow-up, both whether you're continuing in diligence or whether it is a no, and they indicate that they're interested in staying in touch, quantify what kind of cadence works best. And I would emphasize that should work best for you, because you don't want to commit to something that then you're being held to a standard that's just really difficult. But also, for what the LP would like to see and what they want, just to make sure that you're not overextending yourself. So, these are probably best used in instances where, maybe there's a timing challenge or something that they were really digging on, but ultimately, couldn't get across that finish line. And I think the final thing I would add here in terms of just managing kind of the closing of that process, regardless of the answer, is, unless you are absolutely certain that LP is going to convert, I actually would not recommend leaving your fund open for months and months because of, some maybes. I think that gets really tricky. So you want to make sure to manage that and manage that pretty tightly. In some instances, it may make sense. Totally. In others, you may be better off just closing the fund with the capital that you have, getting back to focusing on your business, which is investing and helping your portfolio and your founders. And then you can take what you've done with that time and, again, continue to engage with LPs and those LPs that maybe got to the maybe and close to a yes. And you can double down on that and show them through subsequent conversations what your progress has been. And ultimately that should put them in a better position to continue that evaluation when the next fund comes around.
I will say too, with that, we've invested in funds where they've closed and then they've come back to us 3 or 4 months later and said, hey, this significant LP, or even not so significant LP, but this will help us. They're coming back and they're ready to invest, and they go back, and if the LPA is structured in a specific way, they ask us to reopen and either increase, the target or the hard cap up or extend the fundraising timeline. And then, most of the time LPs are typically okay with that, and we'll sign kind of an extension to it. And I rather you do that and come back to me, and say, can we reopen the fund to allow a couple more $1 million into the vehicle, versus you kind of keeping it open and where's your time being spent? Because for us, I want you to take the capital we gave you and invest it as quickly and as appropriately as possible. Because again, I'm looking to compound that capital for 200+ years and not looking for you to keep it on the sidelines and have it in cash.
True. All right, let's do a little bit of a lightning round. So I'm going to ask you guys a few questions if you want to answer these ones quickly. Generally speaking, what have you been impressed by with an emerging manager recently?
I'd say sharing later stage funds that are LPs in your vehicle. So we're really looking to front run the big brand investors at the Series A, B, and C stage. And so any LPs that you have in your vehicle that you can share are always a good thing.
I think for me, I would say I love when a GP can focus on how they work with their portfolio companies. So how you're being a partner to help them build their vision and company, and not just serving as, an investor of capital. Anytime somebody says the buzzword value add, I'm like, I love hearing what that actually means, not just the buzzword.
Yeah, totally. Are they actually helping? What are your top favorite things in a data room?
Your fund model, it goes to show me that you've thought about this and you've put, pen to paper, and it allows us to go in and kind of stress test what you're telling me you're planning to do. And then also your co-investor list. I want to see what your network is, and that gives us an indication of your sourcing capabilities, especially if you're an emerging manager that's not as established.
I would say definitely a reference list. This, to me, it just shows your journey up to this point, and frankly, other people's conviction around that. We love speaking with founders, just again, the good, the bad, the ugly. It's all incredibly helpful and frankly, just a part of venture. And then the other thing is definitely for us, we love looking at the investment memos. And they certainly don't need to be some crazy polished dissertation, but to us, this is the best window for us into the intersection of, your strategy, sourcing, access, winning, your decision making, and then ultimately that value add piece.
What's your favorite fund metric? Nerdy question.
DPI. Moik. I want to look at multiples.
All right. What's your least favorite?
This is where we both agree. IRR.
Least favorite.
IRR. BS. You can game it and make it real pretty, but you can't live off IRR.
Yeah. Agreed. It's not everything. Fun. Thanks, ladies. There's been some awesome questions that have been asked. So how about we dive in here? Starting at the top from Faye. Are there any resources, websites, or articles that you guys would recommend? I have a few.
I have a lot, but of course I'm blanking right now.
What was the podcast we were talking about this week?
Samir's podcast.
Yeah. With Samir's podcast, definitely. Venture Unlocked. I'd say Winter Mead's book, How to Raise a Venture Fund. That one's pretty good. No, there was a Mark Suster blog post that you guys were talking about.
Yeah, there's a lot of what I think would be probably really helpful is that if you follow a lot of the VCs that are at some of these big branded firms, a lot of them come out and they share different templates. I know ENIAC posted a seed portfolio construction model. So I actually think that as much as there's a lot of jokes that go on it, I think Twitter is actually a great source because you can quickly navigate through what's interesting and what's not, what might be interesting to you, which is different perhaps from the next participant, but then you can navigate through and find some really interesting and helpful materials.
I would also say, don't only focus on the venture ecosystem. There's podcasts out there such as like Capital Allocators, and when you think about LPs, more often than not, they're probably investing in other asset classes as well. So if you can gain their perspective and understanding about why they're investing in the public markets or why they're investing in real estate and private equity, which there's a lot of material out there as well, is to kind of focus in on that. And it can give you a broad-based understanding of their asset allocation and the purpose of the venture portfolio versus the purpose of the real estate or public markets portfolio.
And I think too, I can't believe I didn't say this sooner, but of course the women in VC community, I think the Slack groups, I know I found them even from an LP standpoint, I think they're extremely helpful. I know there's channels that are focused around the templates and different things. If that's what you're looking for, if you're looking for advice around hiring and building your team, I think just talking about that with other folks who are going through the same thing or have already gone through that recently, they can, start to share some best practices there as well, that you might not get in, a strictly written blog form.
Definitely. You can always drop a note in the family office Slack channel, asking family offices questions.
Okay. What are your favorite channels for sourcing new emerging managers? How do you guys source new emerging managers?
For us in the beginning, we wrote some code to parse the SEC website so we'd be alerted of any new manager that actually came to market. And then back to Lisa's point, Twitter was really helpful and social media was really helpful. And PitchBook, of course, and Crunchbase allowed us to discern any information about that manager and if we should reach out. And I did a lot of smiling and dialing for like 2 straight years until finally we invested in enough funds. And I think this question came up further down, but now it's a lot more inbound. So even people on this call have sent me managers. And so the warm introductions, of course, help because I get a lot of intros from attending conferences or attending these Zoom events or being, in the Women in VC channel. And so a lot of it's become inbound based off of our network. But if one of the funds that I've backed has sent me a deal, or one of the funds that I've passed on because they're too concentrated and I like a diversified portfolio has sent me a deal that thinks I'm a fit, I will spend more time reviewing that opportunity than if it's just a cold intro. But I think it's also important just to get your name out there on different channels, not just Twitter. LinkedIn can also be a super informative place where you can message people on LinkedIn, putting articles out there. You don't have to spend significant time and get yourself on VC brags, but finding your name in multiple places can really help an LP spot you and say, it's worth my time.
Yeah, I think we approach it in a similar way, at least for this, is that, traditionally pre-pandemic, it definitely would be just, through being at another annual meeting and bumping into somebody there who knows somebody and like that natural connection that happens from in-person networking. I think, we've also approached it as well from, any of the different virtual conferences once that happened and just attending some of those virtual networking sessions. I find them when you don't have the Zoom fatigue, they can still be extremely efficient where you can quickly meet people, again, make that decision. Do you want to continue to spend more time or otherwise, it's great to meet and you kind of move on to the next thing. So I think networking, whether both in person when hopefully fingers crossed that resumes, but also taking the opportunities in some of those virtual events where they do offer them can be a really great opportunity.
I'd say Raise was definitely a top event for us. We had met a fund that we recently invested in, but we had met them, 3-ish years ago, right at the tail end of them closing fund 1. It just wasn't a right timing fit. And we ended up reconnecting with them during Raise and say, oh, you're back in market. Oh, hey, I'm interested. I remember chatting with you a couple of years back, but there's so many funds out there. It wasn't top of mind. Just seeing them on that virtual platform was like, all right, we need to set up a follow-up call, and it ended up, resulting in an investment.
I like this one. Any pet peeves that you both have on fundraising decks?
How much time do we have?
Is this an hour? How much more time?
For me, I would say, a big pet peeve is talking a lot. Like you can have a bunch of things in the deck, but like if you don't actually show me, and this is very different to each LP, your portfolio construction. Like I've seen decks where they're showing me performance, but I don't get underlying details. What vintage year? How many deals did you do? How much capital did you deploy? Pretty basic information about if you're going to show performance. What's that based off of? And if it's your own angel portfolio and your own personal portfolio, that's technically gross returns. You need to note that, because if you're touting, your big IRR, you're touting performance, that's your angel portfolio. And that's great because that's a great way to analyze your network and your sourcing. But you need to disclose that information, because if you're telling me that you got a 5x return and then I dive in later to realize that's technically gross, and if you had raised an institutional fund with management fees, it wouldn't have been that. Like, just be transparent about it and provide the full information, and don't put on splashy headlines and splashy names and name drop, because a lot of LPs are already know those people are already invested in that specific company or in that specific fund. So just really get down to business and show me why you're worth, I don't mean to be like blunt, but like why you're worth our time. Like you need to show me your edge and why you're worth the time of that LP and why you're worth another follow-up call. Don't put some splashy headlines in there about some, story that you have to tell me that's going to take up 15 minutes of our time. Like, use it wisely and use it to your advantage. Don't spend 30 minutes on your background.
I think definitely for me, in terms of pet peeves around the deck, I've actually made it through, and this might answer one of the earlier questions about, I think it was about like some funny stories, but I've made it through decks before a call. I always ask for a deck before a call so that, again, I can use that, call it 30 to 45 minutes with you. I don't have to spend on the things that are spelled out there, but I've gotten through decks before where there's literally no fund size. And that is just problematic, right? Because that's kind of the whole core of and backbone of how your strategy is going to evolve. So when I go through a deck, I like to see fund size, number of companies, what you're going to be investing in, and who's going to be doing that investing. Maybe there's some other things there, so don't take that to be, only those 5 things. But another suggestion that you can take when you're preparing your fundraising is you can have a deck that's kind of meant for that pre-call, or even a one-sheeter or something, where it's just an overview of your fund, your strategy, maybe the terms. And then you can also have a more extended deck that can actually dive into, and not something that necessarily you'll speak through every single slide, but you can have that available when it comes time for, the next steps or data room, or I want to learn more. And then that way you're not giving away a 45, 50 page deck up front that then you're going to have to repeat on the intro call, but you can continue to tailor your conversations around that. So definitely remember to put your fund size in there. That's pretty critical. And also put who you and your team are as well. I think when it comes to the intro call, I've been on calls before where we've spent half the time going through backgrounds, and, whether I get a deck pre-call or not, I can figure that out quickly from a Google, a pitch book, or LinkedIn search. So think about when you spend your time on that intro call, you want to give materials that will supplement that, and make sure that you're using the time to convey your passion, your interest, your competency, and really talk about your thesis, and not necessarily about, I'm going to do 10 portfolio companies for 10% ownership. They're in the Bay Area. Like, that is stuff that you can communicate more passively.
And you can also put all that information on a deck in your slide. So if it's available, you don't have to then waste 5 minutes explaining it. It's already there. And so the LP can see that. And if they want to speak about that slide in deeper depth, which we probably would, then we can hone in and spend that time, because there's a slide available for it. You don't want to have to ask the LP. You don't want the LP asking you for information that should have already been in the deck, like fund size.
Yeah. And that's something too that keep in mind, I think one thing we've hopefully tried to communicate is that every LP is going to want to go through that pitch differently. So if you're prepared, if you know your thesis, your strategy, your edge, like the back of your hand, which I'm sure everybody here does, you want to be able to, there's going to be some LPs that, like, I hate to say it this way, but they just want to be pitched to, and they're going to want you to pull up the slides and go through every slide. But I can tell you the flip side of that is that I cringe, and I'm like, every time they're like, okay, let me share my screen and pull the slide up, I'm like, no, we don't have to do that. I just want to hear you and the person and the people and the passion behind it. Because that's again, how we approach it. So.
Yeah, totally. On the flip side, since we heard, the pet peeve, what is something that kind of blew you away during a emerging manager pitch, or off the deck, or some story maybe over the last year, since everything's been virtual, that you guys find memorable or outstanding?
I think for us, one of the funds we ended up investing in was a story of how they got into the deal and why they got into the deal. Especially because a lot of times with emerging managers, you weren't part of a prior venture fund, and you may only have an angel track record or just very little data to go off of for an LP to do their analysis on. But if you can, give me a really good example of how you fought your way into a deal, and maybe you didn't get the ideal allocation that you wanted, but this founder wanted you in the deal, and this is why, and you can make yourself stand out, because especially at pre-seed or seed, I know some markets are becoming less syndicated, but it's still a pretty syndicated market. So there's multiple people on the cap table, and that LP could have already been in another fund on that cap table. But if you really explain, I fought my way into this deal, or I left X company and this founder reached out to me and I was able to gather other LPs or other GPs to get on that cap table as well. Just some story like that usually gives me an indication about your passion and, your access and network, and really explains to me, by backing you, who am I front running, or what network am I going to end up getting access to because of you? Because there's a lot of yous out there. So I really need to understand and come away with your edge. Why are you different than the 300 other GPs that are in my inbox?
I think the thing that really has blown me away the most recently, actually, is hearing managers talk about how they've helped their portfolio navigate through COVID. And I think everybody would agree that COVID's come in different phases throughout the past 18 months or so. So I actually really like hearing about, on a call, not just like, oh yeah, I invested and picked these great companies. That's like boilerplate. That's the start. But I like hearing how you're contributing, because the way we work with our managers is we are a very active LP. We do update. We don't just like read your quarterly letter and show up at an AGM and call it a day. So, we like knowing, here's how you helped them navigate their forecast issue, or brought on these partnerships, made these connections, helped them hire these 3 folks that were key to the business. And I think anybody that can navigate through and just talk about the fact, COVID created X challenge, or even absent of COVID, the business encountered this obstacle, and here's what I did to help that founder. And likewise, I think there's also a fine line between recognizing, like, not monopolizing a founder and entrepreneur's time, because they ultimately too want to build the business. So having that finesse, that's more art than science. But I love hearing about those stories. And then to some of our earlier points, we'll go and talk to the founders. And, it's always, I love doing reference calls. I love talking to the founders, not because I love talking to them, they're great, but I just love hearing how they talk about their investors. And you can tell right away whether they have had a good experience or a bad, even if they don't say it was bad. No one's ever going to say it was bad, because that's this business. But you can just tell that they are like spilling over and can't wait to talk about it because it was so impactful for them. So while that's not necessarily, it takes a couple of diligence points to get all that together, that's what gets me really excited. That's what gets me to pound the table with my team to say, like, this is someone that, even if we don't have the bandwidth or the capital right now, like, we have got to keep in touch with them. We want to spend more time with them and find a way that, we can work together. If it's not a fund commitment, for us, we love co-investments. We have a whole entire direct investment program. So, knowing those things, that's how we think about, taking that enthusiasm and pushing it through to, different routes.
References are a great way to showcase your edge. Absolutely. It gives a good understanding to the LP about your soft skills and why you were on the cap table and why you should be on the cap table in the future.
Yeah.
And if you have a track record and, you have a list of companies that you invested in that are not on the reference list, there's ways for LPs to find a way to contact your portfolio companies, even if you haven't provided them with that information. So just please keep that in mind.
I think one question I definitely want to make sure that we tackle is, Stephanie had asked, just how much diligence do you do on the entire investing team and their deal access, or what do you look for in the team as a whole? I think I would even take a step further back and say that you will get this differently depending on the LP. Some will not focus on this, but we focus on the entire firm operation. So for us, because we're looking at this from a long-term capital compounding approach, we care that there's proper fund administration. It's actually important for us to know, whether you have a CFO or whether you have somebody handling platform and understanding that all those things, of course, don't apply at a fund 1 or a fund 2. But if someone is not on the investing team, they are still important in the process of diligence for us. And we like to know their perspective. We like to know their background. We like to know what they contribute. Because if you think about it, even if you're a solo GP, and then you bring on 1 or 2 hires, those additional hires are essentially taking something off of your plate. And so you want to make sure that you don't put some of them back on if it's not a good fit. So I would say in terms of just the entire investing team, we actually expand it to the entire firm. And we do a pretty extensive look. So we will go through kind of all the classic check the box diligence items, but then we will also do our own quiet digging in terms of connecting the dots, talking to other reference points that may be in our network that are connected with you, and different points like that.
I would definitely echo that as well. We'll do the work on the whole investment team. We do run background checks, but we'll only run background checks on someone at a partner level. If you're a junior associate, we likely wouldn't, but that doesn't mean we're not doing references on the junior associate on the team. And we have a in-house CFO that we essentially treat venture capital due diligence the same as we would treat a public market hedge fund, real estate, private equity fund. So for us, we treat it the same way. We just tailor it to based off of how it's structured. So our CFO will, if you don't have a CFO, which more often than not an early stage venture fund doesn't, we'll speak with all your service providers and we'll go through and make sure those boxes are checked. I mentioned before a joke about cash controls, but that's really important to us. So our CFO has an IC vote. So if none of your back office checks, his boxes, then you're not going to make it through investment committee. And so for us, we'll go through the investor due diligence process and really focus on the investment side of the team and run those background checks, but also do a lot of references, especially because to Lisa's point, if there is an associate that was hired, they're hired to take something off your plate, and we need to understand what their role and purpose is there for. And understand what that carry structure is. What is their incentive? Are they really here for the long term? And it's important for us to get to know you because, Lisa says it too, we're long-term investors and we're sticky capital and we're looking to back funds that we can really back for a longer period of time. There was a question about re-ups, but we treat a re-up just like a brand new manager, but there's already an existing relationship there. So we already know you very well and we'll know your portfolio very well. So we still do references, but we already know, a lot of those references that we're going to do. And so we'll re-engage and we will always prioritize a re-up, but we will still do that deep dive diligence and make sure, you're still staying focused on what we backed you for in the first place.
And we approach re-ups the same way. Just again, I know it sounds like a broken record, but given our relationship approach and our emphasis on that, we always we plan out when we think folks are coming back to market, which is why the current pace in the market has been, a pretty hefty tax on our bandwidth right now. But we always try to prioritize those people that we are already partners with, right? We're already married to them. So we want to make sure that you continue now to date through the marriage and make sure that, we know where they stand. Again, it does make the diligence easier when it's a re-up, just given from a time standpoint, because in theory, we're active with them through the entire investment period of that prior fund. So if we can have those interactions, it's actually better to spend that time with us. If you're a GP, we'll spend it, periodically throughout the investment period instead of it feeling more chunkier when you're doing a fundraise process. So we do prioritize our re-ups, just given that, we're already married. And I think maybe one other question, I'm watching the time here, but one other question, I don't know if we specifically touched on, but Rachel had asked, besides the legal docs, what elements do you recommend in the data room specifically for a first-time fund manager? I totally hear you that it is probably a little tricky too when you're thinking about, I don't have a prior fund to reference. I think one thing that you can do, oh, there she is. Hi, Rachel. One thing that you can do is if you do have a prior track record, I think go deep on those companies. So for example, some things that you could do are you could talk about how you sourced that company, how you got introduced, talk about what made you want to invest? Where did you get your conviction from? And then talk about how it's, moved forward since that point. So even for better or for worse, I think it is good, again, to always mention, not just the highlight reel. You certainly want to talk about those. But I would also talk about, the ones where things didn't, go up and to the right. That's going to happen probably. You want to talk about those and also emphasize, what did you learn from it? What did you take from it? And then even if you have done subsequent investments, maybe somewhere that you incorporated that learning into your next investment. So for example, again, this is just a hypothetical, but maybe you found that, you jive really well with a certain founder type. And if you looked at your first 5 angel investments or investments maybe with another firm before spinning out, the three that were successful were really the certain founder type, and the other two were just a little bit different and not a good fit from a GP founder fit. What you can do is you can talk about that in some of your materials, talk about that on whether it's an intro call or a follow-up call, probably better on a follow-up call. But then you can show how that was applied to, you know, the next 5 investments that you did and how those are progressing along. So there's a lot of basic things. I mean, portfolio construction model. I would just go ahead and have a DDQ ready. Like there's some on the ILPA website. MVCA probably has some. I know we have our standard one, and just a note on DDQs, you might find, you know, we have our standard one. It's pretty robust. I will say the questions are probably very similar. So if someone is extremely adamant that it has to be in their template, all you have to do is then, you know, take it from what you've already prepared. So again, a little bit of upfront work, but it saves you when you're really in the thick of it on the fundraise.
I don't know if we have time for more. I feel like we hit the hour.
I know we could all keep talking.
I know.
If any of you guys have questions or anything, you could obviously find me on Slack. I know I'm in the Women VC group on Slack, but you could also ping me on LinkedIn or anything. Definitely happy to chat with any of you in an open door. We may be full of re-ups this year and limited new GP relationships since we do about 9 per year, but you know, we're in it for the long term and we're here to invest, you know, for a very, very long time and compound capital for a very, very long time.
Yeah, I would just maybe end too on, remember, play the long game. Don't let the no's get you that beat up. Know the LP that you're talking to, and good luck. We're here if you need anything.
Yeah, and vice versa. First Republic's here as well to help on checking out your decks before you speak to LPs, and also just advising you along the way. So feel free to reach out.
And Caroline does pass GPs along our way as well. So definitely chat with Caroline.
Thank you.
Yeah, thank you everyone for joining. And what we'll do after the after everyone gets off the webinar, we'll send a follow-up email to everyone here that has Caroline and Lisa and Jamie's information. This was incredibly helpful. I think for all the questions that you guys answer, there are probably like, you know, 5x the number of questions behind that. And so I'm sure a lot of folks are like, oh, no, we're gonna have to do this again. But if we, let's see, we'll send those out. If anyone has outstanding questions or feedback, commentary on the webinar, do let Jess and myself know. And then otherwise, we're gonna look forward to doing more of these because I think they're so informative and so important. And certainly from the Women VC perspective, what we want is more people, more women specifically raising bigger funds faster. And I think everyone, you know, it's probably safe to say that everyone on this this Zoom is in the same boat.
Yeah, and thank you to Caroline and Lisa and Jamie for your awesome insights and just super articulative and direct and unfiltered, and like, it's a privilege. So thank you guys for taking the time, and see everybody soon.
Thanks for having us. Take care, everybody.
This is fun. Bye, guys.
Bye, everyone.